Hi, it's Dave. Welcome. Today I'm joined by James Douma again, and I wanted to welcome you on the show again.
Great. Happy to be here.
Awesome. So today, this week, actually the past few weeks, Tesla,
Mm.
TSLA stock has gone down quite a bit. Um, I know we mostly talk about, machine learning, Tesla, AI, autonomous driving, et cetera. But I'm curious, as a Tesla investor, what have been your thoughts just this past couple of weeks as we've seen Tesla drop from
I
900 down to, below 600?
It's ironic, but I have a great sense of relief that there's a pullback because the stock market in general, I feel this way about. I've been through a bunch of big crashes. Like I've been investing for a long time. I've had a sizable portfolio, and both during the 2008 crash and during the big internet crash back 2002. Like that was painful, because that was the first time I'd really sort of gone through a crash, and in the emotion of the moment, it's hard to maintain perspective. I mean, you've been super happy for a long time because during the internet bubble, man, everything was going nuts, and I had gotten pretty highly leveraged. And watching, like, I had a portfolio that was cut 90% or something like that during it. It was super interesting learning experience. Anyway,
When you say leverage, was it margin or
no, it
options or?
wasn't leveraged. I was just, I was in stuff that I thought was doing that had the most exposure to the potential of the internet, right? And
Okay.
that's the most nuttily volatile stuff, right? A lot of that stuff was super frothy there toward the end, and and it just got its knees cut out from under it. It was quite a roller coaster at the time. But so since then, I've had this kind of contrary sort of instinct to, because what I know is tech, and I invest in tech, and tech can be super frothy and super risky, and that's just one of the things that goes with the territory when you're in that space. And if something's been going well for too long, I start getting that internet bubble feeling, right? So like when it pulls back and it consolidates, everybody gets to take a breath and think about what it's really worth and that kind of stuff. And when it recovers from that, like when you've got a pretty solid pullback and you get a recovery, it's, I don't know, I guess trade, like I'm an investor. I'm not a trader. I don't do options. I don't do anything short term. Like my ideal holding period is forever, and my median holding period is like 10 years or something like that. So like I pick something that I think technological trends are benefiting, and I do a ton of research, and then I get into it, and then I wait a decade, and then if to see if I was right or if I was wrong. In general, it's been super successful for me. But a lot of these things, they go, you watch them go up, you watch them go down, you watch them go up, and you have to decide, is your thesis right? Is about it? You know, if the reason that you're holding a stock is because you hope other people are going to get excited about it and they're going to have an emotional response, and they're going to pay you a lot of money for this at some point in the future, then the psychology of the market can really work against you, right? But if your underlying thesis is, this is reality and this business is going to make money, and even if people don't like it, even if everybody hates this stock, when it's printing money, they will pay for it, right? So that's where I like to go at stuff. And so a lot of the stuff that got me through the internet crash is, like, I went through my portfolio and I looked at people and I asked the question, are these people going to go bankrupt, right? So the market hates them right now. The market hates everything in the internet and in the optics space. And I looked at I got rid of a bunch of stuff, but the stuff I held was the stuff with the stock market just freaking hated it. But I looked at it and it was a solid business so I bought, I was buying what I thought were great companies at like 50 cents a share. It was crazy because I looked at their business and there's no way they're going out. I mean, the market is basically saying, we think they're going out of business. Like, they've priced them down to nothing. And I looked at the business, and they definitely weren't going out of business. Like, they were too important to too many other things that were going on. That, they were going to have a rough patch, and in time it came back,
What
and so
kind
that was
of
a good
um, what
experience.
kind of businesses were you holding
Well,
on
at the
to?
time that was fiber optic stuff, right?
Okay.
Which really got its teeth kicked in in the internet crash. But that was something, I was working at a fiber company at the time, and so it was a market that I sort of understood reasonably well, right? I had exposure to various other sort of infrastructure plays and whatnot at the time. But anyway, about the psychology, like, I look at the Twitter feed and the Tesla comments are all, oh my God, this is so painful. And I just want to say, just hang in there, because, 5 years from now, this is going to look so different. You're not even going to remember this. And I like to, take the stock market, or take some stock that's been around for a long time, plot it on a log chart, and look back over the last, 15 or 20 years. Do that with Amazon or something like that. Mm-hmm. You can do it with Tesla, actually. I have a great little chart of Tesla that I send friends who are like annoyed about this. And it's cool. You plot Tesla on a log chart, right? And you put a 50% growth line, 50% of your growth line through that thing, right? And you look at that and it's like, wow, everything's just going click, 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 right according to schedule, right? Yeah, I mean, it's way above the line for a while, and it's way below the line for a while. But you can really see there's a very clear underlying trend that the performance of the stock is tracking with a huge amount of volatility, but it is tracking the underlying performance of the business solidly, because that's Tesla's got a 58% CAGR or something like that if you go back to when they first started making cars. And, the stock price over the long term, it tracks that, right? So if you think that Tesla is going to be able to maintain that, that their underlying business is going to continue to execute, the stock price is going to come, it'll bounce around that line, but it's eventually coming back to that line. And when it's below that line, like if you believe the thesis, you're just like, hey, it's on sale, I'm going to buy some more, right?
Mm-hmm. Yeah.
So I feel pretty good about it myself, which makes me unusual, I guess.
Yeah. Do you notice at all, like when the stock price goes down a lot, let's say in this case, 40% or something, that you get more bullish kind of on, like you feel like your conviction is even, I guess, sometimes I feel like that when the stock price dips immensely, then it just feels like it's more of a value, and like the longer term convictions or thesis. And
well, if you buy today, you're going to get a better multiple than
exactly
you got at the higher thing. That's certainly true.
Yeah, meaning like when the stock price is really exuberant and buoyant, everyone thinks it's just going to continue to go to the moon. I'm a little hesitant. I'm kind of a little bit contrarian in that sense, I'm kind of like, there's more risk than what people realize. But when everyone is just scared completely, and it goes down, even if from here, if it goes down even more, I just get more bullish. I get stronger conviction. It's kind of this weird dynamic. I think it's
like in 2008, I remember like my relatives who were in the stock market, like I was having to talk them all off the ledge. They were just like, a lot of people I know were just like bailing out of everything. And I had that experience with the .com crash or whatever. I at the time I went back and I did a careful walk through stock market history, and I looked at the crashes in the past, right, and looked at how the market recovered, and the market recovers from crashes amazingly. I mean, 3 years might seem like a long time to somebody, but like the biggest crashes, they last a year or something like that, or they last, you have to go back like 100 years to find a crash that lasted like 3-4 years. The 2008 was long. At the bottom of 2008, like after it had been just falling, like I sold every conservative thing I had, and I bought the most crazy, high volatility stuff that I could. I just flipped everything because I was fully in the market already, right? Like I couldn't get any more in the market. And when it bottomed out, I was like, God, I so wanted to be able to buy stuff. So I sold everything I had that was conservative, and I bought stuff that was super aggressive. And I made a killing. It was great, right? And at the same time, I was having to convince people. I was having these, I was having these long conversations with people, just like, it's going to be okay. Wait, it'll take a year. It'll take 2 or 3. And most of the people I know kind of held in there, but the people I know that got out, if you get out at the bottom, the psychology is terrible, right? Like you don't want to get back in. You're just like, the stock market is dead to me. I'm never going back to it. And the thing is, after the crash, the first 5, 6, 7 years after a crash, those are the time you want to be in, because that's when first you've got that return to the normal, right? Which is there's so much economic pressure on that forcing function that pushes the stock price back to the norm, right? And then it tends to overshoot too after it gets back, because by the time a couple of years have gone by and you were at the bottom of the pit, even when you get back to the trend line, for the long-term trend line for the market, people are like, hey, it's been great for 2 years, and they're still piling in, so it overshoots, right?
Yeah.
So that's definitely when you want to be in. Like if you're ever going to be in the stock market, you want to be in during the 3 years after it just crashed or whatever.
Yeah. What were you buying? Like, what did you the 2008 crash when you were transferring from more stable assets to volatile? Like, what were you doing? What kind of
I
stocks were you
bought
getting?
junk bonds, which is something like I don't
Really?
really like debt,
Uh-huh.
but I look and I don't buy bonds. I bought this junk. In fact, it's funny. I just saw that I just sold this stuff because I wanted cash because things are cheap right now. So because it was the least appreciated. Like I've got so much stuff which is up like 2,500%, and selling it like the taxes are super painful, right? But the thing about a junk bond fund is like you get paid. It pays out in dividends. Like the base price, it'll go up and down, I don't know, 50 or 100% or something like that. But it stays inside a window if you look at it long term. And excess returns, they pay out in the form of dividends, right? So I was just going to keep this until, forever, essentially, because, it'll just keep paying dividends. But recently, the stock market has gotten pretty cheap, and it was the least appreciated asset. It was only up 100%. It was the least appreciated asset in my entire portfolio. So I had to get rid of that. But yeah, most of the stuff, like I had a bunch of S&P. I just use it for storing cash, right? And then so I had a bunch of S&P 500 stuff at the time, and I dumped that, and then I bought tech stocks, right? Like I felt like Google was really cheap at the time, and I bought Google. I felt like Apple was really cheap at the time. I bought Apple. That was when I bought the first Amazon during the crash, because I don't really know retail, and I love Amazon. They like all my clothes come from Amazon, all my food comes from Amazon. I think they're a great, great business, but I have a really hard time understanding the fundamentals of that. So I'd never invested in them, right? And then it was just like, man, they're super on sale, it seemed like. And so I piled into Amazon, and that's been like the best performer for me in that over that whole window of time. So I was not buying stuff I had a huge amount of insight in.
Yeah.
I was buying stuff that I thought the overall technology trend and the trend toward, information services and that kind of stuff, and people who already had a track record of executing pretty well. So no insight there. I just went from the least I took all the lowest volatility stuff I had and sold it, and I bought the highest volatility stuff that I had confidence in.
I see. Did you hold on to stuff like Apple or Amazon?
Yeah, man, selling that stuff after it's gone up 3,000% is really painful. Yeah, like I can't get rid of it ever. I don't think. And it's tough. I had a lot of random index fund stuff that I was just using for storage, but man, I'm running out now. It's like and now, if the stock market does a big bounce, I won't be able to do that same trick again because of how painful it would be. On the other hand, I got Tesla going for me now, which is I'm super happy with Tesla. I'm super happy with Tesla, not because it's performed well, but because no matter how critically I scrutinize the underlying business model, it just seems like you describe it as generational, and I think that's a good way of talking about it. It's one of those, like for me, I'm a tech guy, right? And Tesla is in technologies that I basically understand. Like I worked in electric cars. I worked in an electric car company. Like I know that business. I know tech and IT. I developed a lot of software. So I feel I'm really comfortable evaluating the space of technologies that they are dependent on. And when I do that evaluation, like I have a really, really hard time coming up with scenarios where they fail or where they don't prosper even. It's really hard to do that.
I'm wondering, how do you separate, let's say, the company, how they're executing, how they're progressing toward innovation and growth, et cetera, versus its stock price? Because a lot of people, I think, they look at it kind of combined, right? If the stock price is going up, they think the company is doing better. If the stock price is going down, they think something's wrong with the company. But in your mind, how are you dichotomizing these two? Are you focusing more as the company's performance, like execution as the core thing, and then the stock price more as like a lagging indicator, or just, fluctuating based on sentiment and just kind of going up and down? Like how do you wrap your mind around all this?
What I want to say is I don't buy the stock, I buy the company, right? And to some extent, my sense is that stock price variations fix themselves in time. And sometimes you wait a long time. Like I was in a company where I was sure they were going to recover in the next 2 or 3 years because they were in just a great spot, right? And it took 10 or 15 because like they were in a sector that had been really severely punished because of some massive overcorrection, and it was kryptonite to investors for a really long time. They wouldn't touch it. But the underlying business was solid, and they were not a business that was. I mean, they were cash flow positive, so they didn't need financing from the market. So there wasn't anything about the price of the stock that was that was itself a threat to their business. It was just investor attitudes about it. And, investors took a long time to get over the shock of like all the money that they lost in the industry that this company was in. And, but it came back in time. And so that's my takeaway. Well, so one of the takeaways is like, don't be so overinvested in one thing that you're forced to sell it at a bad time, and understand that there are, sometimes if you're in a stock where, you want the multiple to be high, or you need the multiple to be high to satisfy your investment thesis, that it can take a really long time for the market to become enthusiastic about a stock, right? And since then, I try to avoid stocks. I try to avoid investments where, like, my underlying thesis is people will get excited about this. In my 20s, one of my first big bets was like, I started playing around with Linux back when when it was something only hobby people did. And I thought it was just like, this was the greatest thing ever. It was going to be, people were going to get super excited about this because like you could do all this stuff with it. And it was really hard to find companies that were exposed to Linux, that were publicly traded and whatnot. And I had to search for a really long time. And I made that investment paid, like I ended up flipping that investment like 6 months later, and it paid 9,000%. I mean, it was a stupid, totally got lucky, right? Because there was all this Linux hype that just kicked in. At some point, IBM got really excited about Linux, and it just took off, and I sold it. But that was just a lottery ticket, and I knew at the time it was a lottery ticket. And my response was like, don't never, ever do that again, right? Because you don't want to be lucky. You want to be smart, right? It's better to be smart than to be lucky. I mean, being lucky is great. It's nice to be lucky, but you want to be smart. So I just don't let myself do that. That investment, I was consciously, people are going to be excited about this at some point, and I'm going to buy it. And then they'll get excited, and then I can sell it when they're excited, and I'll make good money. And I did. But then after the fact, I thought that was really stupid. You shouldn't do that because you can't rely on people. There are too many factors that go into psychology. And it's just, there are probably people who are a lot better at understanding it. Like, I feel like your read on the market is much better than mine. And when I watch your conversations with Emmett, I get a similar impression to him. Like, he's got a set of habits and he talks to the right people. I don't feel like I can do that. I feel like it's very dangerous for me to try to make a prediction about what people are going to like or not like. And so I go in the exact opposite direction these days. I try to just pick stuff where it doesn't matter if you like it. It's going to be worth a lot of money anyway.
Mm-hmm. How do you deal with like the fluctuations in your portfolio value? I mean, I'm sure the past month or so you've seen your portfolio value drop a significant amount. Do you just not count your portfolio value as kind of real in the moment, or do you have like a lot of flexibility in how you view that, or what's your kind of take on that?
I think of all of it as stuff that I'm, I don't care what it does, but I care about what it does in 20 years. Like, I don't think of any of that as money I'm going to use in the next 20 years. It's like I have this other pot of money I live off of, and the portfolio, I'm managing it for the maximum possible value 30 years from now or 40 years from now. And my experience is that you have 2, 3, 4, 5 years. I went back and I did a study of like historical stock market prices, so that you can get data on the Dow Jones going way, way back, and the S&P 500 going back like 100 years. And I couldn't find a 30-year period in that whole thing where it didn't revert to the mean after 30 years. So that's sort of what I keep in the back of my mind. Yeah. No, your worst case is that it takes 30 years to recover. And 30 years is the extreme case. It's typically a decade or something like that. Absolute worst case. And this is after major dislocations like World War II, the Great Depression, real calamities. Not these, the financial system froze up and everybody lost confidence kind of thing, but like something in the world really happened. And that's your worst case scenario, right? And then, if a meteor hits the planet, we're all dead anyway, right? So, I mean, there's some things that aren't worth worrying about, and the biggest things that are worth worrying about, they last a decade or two. So if you, which I try to do, maintain a frame of mind where, it's a decade. I don't need the money before then anyway, right?
Yeah.
That's how I do it.
If you don't mind, what percent of your portfolio is in Tesla? Like how much percent does Tesla make up?
Oh man, a lot right now. I haven't looked at it since it's been down.
Yeah.
It peaked at 75%. Okay.
Like that. Got it.
Yeah. A while back.
Yeah. Interesting. Yeah. Fascinating stuff. I feel like a lot of times it's our perspective that changes our perspective, let's say in investing or why we're investing or what we're shooting for, that changes how we react to the day-to-day, fluctuations and stuff. So, I mean, it's interesting to hear your super long-term perspective, 10, 20, 30 years down the road, investing in, it seems like you're really catching a core of your investment approach, which is you want to catch like these technologies that are really game changing, but you want to catch the companies that are really, doing the best or executing the best, really utilizing those technologies in a way where, like, what are your thoughts? Like, there's a great technology and a company is utilizing it, but what are the parts? Like, do they just need to understand it and implement it, or do they actually have to create a product of value and
it's really complicated.
Continue to maintain their competitive advantage? Like, what are your thoughts on like how you evaluate that?
Man, I don't know how to summarize that. My general thought is that so I tend to look for individual companies, right? Like I pick like big, highly diversified things to just store money in, because I don't want to think about what's inside there. I just want to look at their track record over time and how they're affected by the macro environment and say, okay, that's a good place to just keep some money that I don't need right now, or stuff I want to take off the table. Individual companies that I get excited about, I feel like you just have to really understand it's really hard to generalize. Like every company that I've been super excited about, and there haven't been that many. Like I've had maybe a half dozen really great investments in 30 years, something like that, right? And then the rest of it is just storing stuff. And Warren Buffett has this thing about has this line where he says, the simplest way to make any investor much better is you give them a lottery ticket, which has got 20 punches or whatnot. Like, you only get to buy 20 things in your whole life, because that'll make them really think about the investment that they're going to do. And while I don't, Buffett and I have super different styles, that the idea that this is for me as an investor, right? There are people who trade, and I got plenty of respect for them. I have friends that got super into trading at times when it was really popular. Really smart people. They work really hard at it. And some of them have done great, and a lot of them have just been run over by a truck, right? Because trading is really, really, really hard. And I just don't want to work that hard, so I don't trade. The alternative is, if you don't want to trade, you have to have a long-term time horizon, right? Because there's nothing that you can do over a 2, 3, 5 year time span that doesn't require you to understand the psychology of the market and understand the macro environment and be able to factor all that stuff in, which is work. It's a lot of work. And, I'm a geek. I like the tech, and I'll get super excited about something. I will study it to death so that I know it. And then I'll go looking for people who are making the best use of it, or they're most exposed to the potential for this to explode. And 9 times out of 10, I don't find anybody that I'm happy with. Like the comment I made about Amazon, like I've been an Amazon customer since like almost day one. If you stay home and you want your stuff to come to you and you're an internet nerd, when Amazon, that was like the most amazing thing in the world when it showed up. It's like, man, it just solved all my problems. Like, I used to be the kind of guy that like I'd go do my Christmas shopping on December 24th, right? Because I was always really busy with all of this stuff that was going on. And when Amazon showed up and I could just go to Amazon, like you could find something for anybody on Amazon. You could sit there while you were working, open a window, order all the stuff. You don't even have to wrap it. You can send it right to their house.
Uh-huh.
Like it was just the best thing in the world. And yet I didn't buy it for a really long time because I didn't feel like, even though the internet is such a big trend, right? And the way that people respond to it, the way that it affects the world is really complicated. And so being able to make a long-term, like when Apple, like I understood the argument that, the internet's taken off, mail order is the thing. The internet is like mail order on steroids. It makes it so much better. It makes it a million times better, quicker, so much more convenient. It can drive the cost down. And Amazon's idea of like, yeah, we're just going to iterate. We're going to make the logistics better. We're going to study the data. We get all this data on how people use the service, and we're going to turn that crank, and we're going to understand what they really want, and we're going to refine our business model to maximally take advantage of that. But even if you knew all that stuff, looking back at that, if you tried to look forward, you could say, well, the trend looks pretty good. But, Walmart was a giant, and there were big players out there that really wanted to get into that game. And you ask the question, okay, so Amazon's nimble and they're clever, but are they going to survive when really big guys come in? And I thought they would probably do well, but not aside from that question, there's 10 other important questions that you really want to understand about the business. If you're going to make if they're one of your 20 punch cards, they're one of the ones that you're really going to make a commitment to. You really want to understand. And Amazon, it was just too complicated for me, right? There were too many big questions that I thought that were really important that I didn't feel like I either had the time or the expertise to understand as thoroughly as I needed to make a big commitment. So instead of buying Amazon, I went looking for something else that I felt like I could understand and I could make a big commitment to. And, it takes some of those, sometimes, 8 years go by and I don't make an investment, right? Because I just can't find anything.
Mm-hmm. Yeah. How often are you looking at stock prices? I'm curious.
So I think of stock prices, especially if you're talking about your portfolio.
Yeah.
So there's a super simple model of like, things that make you feel good. When you do them, you get a little dopamine burst or something, right? You have a little positive neurotransmitter response to that. And things that make you feel bad, there's some opposite negative neurotransmitter. You're getting positive biological feedback or negative biological and psychological feedback. I make a conscious effort to look at the stock prices a lot when the stock price is going up and to not look at them when it goes down, because I want investing to be a good experience. I want to have positive reinforcement. I think a lot of people kind of get in the opposite zone where like, oh, it's doing fine. It's in my 401k. I won't think about it. And then the stock market crashes and they're refreshing it every 15 minutes, right? And, it's like I think of people as like machines or animals or something like that. Like most of our psychology is pretty basic stuff. And I think of myself in the same way, right? That we have these sort of psychological biases or traits or whatever the deal is. And it's worth getting a general idea of what they are and then trying to craft habits that get those behind you instead of having them be obstacles to you. And I feel like, and once again, if I was a trader, it would be very different, right? I'm sure Emmett, when the market's going down, he's got plenty of reasons to be refreshing the screen all the time, right? Or to have stop losses or, whatever things that people do in that situation. And if you're a trader, there's opportunities both ways because you can go short, right? But kind of buy, I don't go short. It's just not something I do. And so there's no opportunity to me in the downside until it bottoms out. And then like when I feel like the market is really thoroughly bottomed out, and if I'm feeling really good about things, then maybe I'll do something elaborate and risky or whatever. Like if I'm really convinced that the macro environment is at a turning point, and the next like 6 or 12 months are going to be amazing, then I might do something. But mostly I try to not do things that are not in my space of expertise. Yeah. And I really like I've cultivated an ignorance of trading because I don't want to be tempted to do it.
Yeah. So when the stock price is going up, like how often are you getting your dopamine hit? Is it like several times a day? Or you're just like looking at it,
it's not as
or just
it's not as not that much.
okay,
Right?
okay.
And it's kind of wearing off for me because there was there's a certain amount when your portfolio is relatively small and when money isn't a big thing to you, right? Then seeing your portfolio go up is like life changing, right? Like you can see an amount of money in there where you're like, wow, the possibilities are increasing for like, how I could live my life or the things I could do to, help the people around me or whatnot. But then eventually you get into a zone where it's not going to make your life any better, right? I mean, if you're a sane person who has a reasonable lifestyle, there's a limit to how much money is actually going to make your life better, right? And so once you get outside that zone, and that was what happened to me. Like once I got outside that zone, it was like, now it's a score in a video game pretty much, right? And because it's a score in a video game, like I can get super excited about playing a video game, right? But when I walk away from it, it stays in the computer or whatever the deal is. It doesn't have long-term consequences for me. And so the portfolio is largely like that too. It's you get into the zone where it's literally going to take an asteroid strike before your portfolio collapses to the point where like your lifestyle is going to decrease. And it's, the main thing it affects is like how much money you're going to give to charity because you're going to do something with it. Right. Yeah. And if you can't use it, you're going to give it away.
Yeah.
So,
yeah, I can relate. Like, cause this morning I was like, what the heck? It's like, whatever happens to the stock market, or to whatever my portfolio, in my situation, it really is, it just affects my giving, and what I do with it. It doesn't affect my lifestyle because that's already, taken care of by other assets and stuff. So it's, in that sense, I can relate in that sense. It's a different perspective, I think, at a certain point.
I wanted to talk to you at some point about the philanthropic thing, because it seems like you have a significant history with that. And I saw a couple of your videos where you were talking about your background on that. And so that's something I'm having to worry about more and more these days. So
yeah.
Anyway, if you got some recommendations for good books or something like that, I'd love to hear them.
Yeah, definitely. I think, the philanthropic approach, it's definitely something that I think at a certain also place and level that becomes an increasingly, like as you get, the more assets you have beyond, your own kind of livelihood, and then add on to that age as well, then you want to make those assets count in some ways. And I think passing it on or giving it or to people who might not necessarily need that money per se, that is a role or a place. But then there's also this role of what can we do with it beyond just something bigger, like aiming big, with giving and philanthropy, or giving. I personally, I'm still sorting out a lot of that stuff. It was one of the main motivations for me to get into investing, because I knew there was something with investing that could multiply exponentially, resources for good. But I'm still probably in this journey of trying to figure out exactly, what that looks like. But would love to definitely chat more in the future. Sounds great. It's thanks for sharing your thoughts on Tesla. This is helpful for me. It's actually some things I'm going through the past couple of weeks too. As the volatility goes up and down, I'm also thinking more like longer term. It's like, what advantage do I have over other investors? And a lot of it is what you're talking about, seeing the longer term trends, some longer term technology. It seems like in this decade, like AI is one of those just huge things that I think it's almost like it gets to this point where 10 years from now, 2030, we're going to look back and say it was obvious, like machine learning, AI, all this stuff it was obvious. It was like one of the biggest things to happen this decade. But when we look forward now, it's obvious to certain people, but it's not obvious to the mainstream, to the masses, that machine learning, AI is going to be one of the most dominant forces that changes business. It changes,
Another way of thinking about that is that people kind of know, like there are plenty of articles, and there have been articles going back a long time talking about how like AI, it's a big trend, it's going to affect everything, but it's really hard to get your head. to like make that something concrete, right? It's as long as it's this vague, yeah, things are gonna get better, right? It's it's gonna cure cancer. It's gonna there's all of these kind of vague, far in the future sort of promises. I think that when it gets concrete, when 2 or 3 or 5 or 10 things that it's going to make a big difference to, and they all matter to a lot of people, then it's a lot, like somehow once it crystallizes into something specific that then that you can get your head around, then it's real, right? And until then, it's some science magazine writers just sort of take on something he's excited about, right? It doesn't seem real. And the transition between those two is a strange thing, because it definitely becomes concrete for people at some point. And as long as it's not concrete, it kind of doesn't exist. I mean, you can know in an abstract sense that it's happening, but it's very difficult to act on that, right? To be the kind of person where you draw a graph and you do some math and you see something and it says, your math says this thing is going to happen, but everybody around you believes it's not going to happen. Like, it's very hard to be the person that acts on that, to just like shrug off the skepticism of the whole world, everybody you're surrounded by, and then act on this thing that you believe because like you did some math, right? That's a really hard thing to do. And so that I mean, I'm mentioning that because that's kind of what investors do, right? But that same phenomenon, I think, it happens with the general population's sort of view of things that happen in the future, right? Or how the world is going to change. Is that most people don't see it as real until everybody around them believes it, and most people, they don't believe it until they see it, when it's concrete and it's real and they understand the role it plays. I mean, Steve Jobs could stand there, on the stage, and he could hold that first iPhone out there, and you could look at it and you could say, wow, that seems like such a great idea. You can imagine, just in an abstract sense, all the things that you could do with it, right? But it didn't take off until like your friends all had them, right? And you saw, oh, there's this app and that app and this game, right? Then it was concrete. And while you could have, like, all of that stuff was totally foreseeable. I mean, there wasn't anything, sort of really unexpected about any of the things that happened on it. And yet everybody didn't rush out and buy iPhones, even though, it's funny, back then people were talking about how expensive they were, right? Yeah. The thing is, they cost twice as much now, and everybody buys them, right? Because it's so obvious that it has value. But back then the value was abstract, and so people just don't act on it when it's abstract, right? Even though they can know, on some level, it's going to happen, and yet it's not real until you see it in the real world.
Yeah. I remember the first iPhone. I had the first iPhone, and I remember I loved that thing. I was like, this is the future. And my wife, who wasn't my wife back then, but we were working together, I remember sometimes we would eat dinner with teammates, and then I put my iPhone on the table at a restaurant or something, and she was so embarrassed because she's like, that thing is like, how much? $600, $700? It's just take that off the table. It's just so conspicuous,
Pretentious.
Yeah, pretentious. Like, how could you have that just laying around on the restaurant table, an iPhone. Who needs an iPhone? It's like totally waste of money. I couldn't understand it completely.
I thought there've been all of these interesting sort of tech things that sort of had. I remember when the first Apple came out with the first watch, and there was the 24 karat gold, whatever version that cost like $10,000 or something. Like, what was up with that?
Yeah,
right? Or the Google Glass thing, right?
Yeah.
I mean, that was kind of on the opposite. That was just like this silly experiment, and yet, because you put it on your face, somehow it was really pretentious, right? People have strange reactions to things, and that's one of the things that makes me. The fact that stuff seems so weird, right? That you look at like, why are people responding that way to this thing? Makes me very unconfident of my ability to predict what the next big thing is going to be. Like if you'd suggested like TikTok was going to be big, or it took me a really long time to get onto Twitter because I just didn't see the point. Like I couldn't see it. Like email, I got that. Like I was around back when email was new, right? And man, email, I was like right on that kind of stuff. And text messages, I got that. I saw how that was different. But Twitter, man, who would want Twitter? Like, what's that good now? And now I spend half my day on Twitter. Like I get it, but I can't really explain it, and I don't feel good about getting it.
Yeah. That said, all of this is one of the reasons why I'm so excited about Tesla's full self-driving, because it's one of those concrete examples of what you know is inevitable. Like we're talking about one of the greatest kind of technological changes or impacts with AI in our history. And you have this awesome, amazing concrete example of Tesla full self-driving in a consumer application, right? That you can actually go out, drive and watch its progress and see its impact in daily lives. Like every single person's life is going to be impacted by full self-driving in the next 5 or 10 years, you know? And to see the magnitude of change, but then to see what's happening in the infancy stages, the first inning, and how it's constructed and how it's built and the challenges it's facing and, you know, what it has to overcome. And to understand that, it's fantastic, because then you could not just understand the next 10 years, but then you could see the unfolding of this in various different areas, you know, of life and the world. And so it's kind of like a key in a sense to help us understand not just full self-driving, but to understand how this affects perhaps many different areas, which for the majority of people, they're not going to really get until it's after the fact, you know, until 10 years down the road, it's already impacted everybody and it's obvious. But I think there is an advantage when you can understand it before others. There's this window of, you know, the world is skeptical and it's discounting its value, but you see that this is inevitable and it's just undervalued at that moment. And there's something special about I think those type of investment opportunities.
So Peter Thiel has this line is like, I'm just paraphrase it, is the opportunity comes when there's something you know is true that everybody around you believes is false, right?
Yeah, definitely. Super excited. So what we're going to do is we're going to have a part 2, perhaps part 3. I'm going to divide it up into a couple sections. But this first part was just talking about Tesla stock, philosophies, approaches, and kind of impact of AI over the next 10 years. We're going to move into full self-driving and going into the nitty-gritty of some of the more specifics. I wanted to ask you about Operation Vacation, also competition. Can other competitors catch up to Tesla's approach? When can they catch up? And then a biggie is, how much is full self-driving worth to Tesla's, you know, enterprise value or their valuation? How do we calculate? Is there any simple models that we could use to help us understand this? So we're going to wrap up this episode, and will be part 1 for this week's talk, and then we'll go into part 2 soon after. All right.